Hi everyone, this is Tim McCusker, Chief Investment Officer for NEPC. Thanks very much for joining us today for our 2017 Investment Manager webinar. We've been having this webinar for several years now, and I think it's hopefully been informative to investment managers. Really, it's a great way for us to be transparent about our process and about our team, who's covering what categories, so hopefully you find it useful. We'll reiterate this a few times throughout the presentation, but slides will get sent out after this, so no need to ask us 100 times. The slides will be included. We will get those out to you, and we will post a recording of this on our website. So our goal today, and always, is to work constructively with you, the asset management community, to help our clients meet their long-term objectives and exceed their long-term objectives. The ideal world is one where managers deliver great returns, we look great for recommending those managers, and clients look great and feel great because they're delivering great returns to their constituents and meeting their objectives, whether that's delivering a pension benefit, supporting a community or hospital, or fulfilling a family legacy. All of those things are important, and I think we recognize that we only do that through a partnership by working closely with our clients, but also with asset managers. So today, you have me, you have Christy Hansen, our Director of Taxable Research, who joined us at the beginning of the year and is helping us really raise our profile and expand our efforts in the private wealth world, and Christy will talk a little bit about that, but that's certainly a focus area for NEPC as a firm, and particularly for research as we look to build out our knowledge of strategies that appeal to that marketplace. And then Hayley Tran, who covers fixed income for us and is a senior research analyst on the traditional research team. I'm going to run through a quick NEPC update, tell you what's been going on here. Christy is going to take you through client perspectives and a market outlook, as well as a private wealth update. Hayley will tell you about active management and our perspectives on what we're seeing there, that active versus passive discussion and the flows that we've seen in the last few years, and then an overview of NEPC research and our process. And then we'll take you through investment manager searches and activity that we've seen with some final thoughts, and then we'll leave some time for Q&A at the end. So NEPC, not much of a change here, which is certainly a good thing for us. We think our stability is a real differentiator in the marketplace. We're a team, from a research perspective, a team of 49 dedicated research professionals covering the world across dedicated asset allocation, long-only traditional research, hedge funds, private equity, private real assets, and operational due diligence. We think having that depth of resources allows us to have really specific expertise in each of the underlying categories within those broad categories, and that's really important for us to be able to deliver great advice to our clients. And that's important for our consultants as they work with clients. You can see in the bottom chart, we made the decision many years ago, recognizing even then when things seemed to be getting more complex, they're even more complex now, that our consultants needed to have the bandwidth to address the increasingly complex world that investors were facing, and so built a model that relied a lot on research to deliver those great ideas to consultants to work with clients. And we have roughly a 6-to-1 client per consultant ratio and expect to maintain that well into the future. We want our consultants to really build customized solutions for our clients that help meet their long-term needs, whether that's through the asset allocation process or through manager selection and portfolio construction. All of those are important. In terms of some of the numbers, we have roughly 350 clients. You can see the diversity there. I would say we pride ourselves on, within the consulting industry, having the most diverse business across many different client types. Total assets at $954 billion. If you happen to know a $46 billion asset owner that would like to work with us, we'd love to get to $1 trillion very quickly. But that's slow and steady growth for us, and we expect that to continue. Total funds, we were working with many different client types. Many of them have multiple pools of assets, whether it's a corporate plan with a defined benefit and defined contribution, a healthcare organization with operating assets that function more like an endowment, a defined benefit plan, defined contribution, and insurance assets, or families with many different pools of assets with different jurisdictions. We work with all different kinds of clients and work with the many different funds and asset types that they have within their construct. And then a little more than 250 employees with about a third of that in the client servicing role. Research is about 20%, and then performance and back office making up the balance of that. Somebody take any questions at the end about NEPC and where we are as an organization and things that we're seeing in the marketplace. But with that, I'll turn it to Christy Hanson to give an update on private wealth and what we're seeing from clients these days.
Great, thanks, Tim. So as Tim mentioned, the private wealth initiative that we have as a firm, and on the next slide we will show a little bit about what that looks like. So we have a strategic initiative to grow the private wealth area, and we've laid it out into a few different areas. One, the first of which is hiring experienced private wealth professionals. To date, we've hired 7 professionals that are working on the private wealth space that complement our existing professionals across the country in Boston and Minneapolis and in other markets that are working with our private wealth clients. We've also opened a Portland, Oregon office, and that is where I sit and 6 of my colleagues in Portland right now. So we're excited about that accomplishment thus far to date. And we're also, as we work through this, looking at our FPLs, our focus placement lists, which to see what managers and which strategies and which opportunities are appropriate for our private wealth clients, both the ones we have today and those that we hope to achieve in the future. And so that is really working with our existing research professionals, that team of 49, to help identify those strategies, as well as doing some focused things ourselves, introducing new strategies and finding those that are more tax sensitive, that are appropriate for those clients. And we'll talk about that a little bit more later. And then finally, of course, developing a comprehensive private wealth focused marketing and business development plan, and our goal obviously is to execute on that plan to grow our private wealth area. So already year to date in 2017, we've added a few new clients, and we're really excited about that and are excited about the prospects of growing this part of our business. And so what does that mean for research? We have a few objectives that are specifically research focused, and as I mentioned, what we're hoping to do is really expand on the best practices that we have in place already for our research processes to make sure that we're capitalizing on the opportunities that may be unique for private wealth. As you know, private wealth can be a little bit more flexible, different time horizons, different risk tolerances, and of course then the tax burden that you have to consider. So there are some different strategies that we may be adding to our FPLs over time. We're also, of course, working within the structure that we have in place and the good research in terms of where the market opportunities are and finding strategies that fit within those opportunities. And I'll talk about that a little bit later. And then also working through, on the research side, a little bit more emphasis on the tax implications of various strategies. And to that end, we have a current project ongoing where we're evaluating hedge fund taxes. And so we're doing an analysis. To date, we've captured data, K1 data, from about 70 or so funds over time, so multiple years on some of those funds, and doing some analysis in terms of what does the tax, do the tax characteristics change, strategy to strategy, which we know that it does, but what is that tax burden, and how does that compare to other investment opportunities over time, and where does it make sense in our client portfolios to take on the maybe less tax efficient strategies, and where does it make sense to capitalize on some more tax efficient strategies. And then the other initiative we have is the direct investment platform, which we'll talk about in a couple slides. So first of all, I just wanted to talk a little bit about taxes. It could be that all of our analysis will get thrown out the window under a new tax regime. But it is important to understand, what are the implications. What we're seeing too is that because of the uncertainty, in tax policies and where it's going to go, it does cause some volatility in certain asset classes in the short term, and so that can create opportunities for buying and selling and arbitrage opportunities, which, as you of all people know, that these are some areas to take advantage of. And then, we'll take more of a stance as these policies become a little bit more clear, and working really closely with our managers to understand what they're seeing, what you're seeing, and what that means from a tax perspective. Some of these opportunities that I see from my seat that could happen would be refreshing portfolios, especially those that are more tax efficient and have a lot of embedded gains that we maybe want to refresh the basis on. Could be doing that, especially in our passive strategies. Any potential changes in the municipal market, as if the private-public partnerships gain momentum, and what that means for especially the taxable clients, and then of course any opportunities for domestic M&A if more cash is repatriated, by positive, favorable tax policies. And then finally, on the tax side, the work on the characteristics of hedge funds, which I already described in terms of what we're doing. The next area that we're looking at is the direct investment framework. Direct investments, especially in the private wealth and the E&F, the endowments and foundations area, have become a lot more popular. A lot of requests from clients in terms of trying to achieve different types of objectives and potentially higher returns. And we know that this area has a lot of pitfalls, and as well as a lot of opportunities. And so what we're hoping to achieve is to identify a framework for identifying co-investment or direct investment partners, and doing some due diligence on the partners, and see if the deal flow that those partners can add could be additive to our client base. So if you see at the bottom of that slide there's some statistics that came from the Family Office Exchange and then Camden Research, which also works with private wealth, in terms of the amount of direct investing that clients want to do and are doing. And you can see that a strong majority are engaging and hope to engage in direct investing. So on the left-hand side is 69% that are. And then the other chart, which is a little bit of an eye chart, I do admit, in terms of where the opportunity sets are coming from. And a lot of these are coming from either co-investments or club deals or sort of family office to family office type situations. And so again, we're hoping to capitalize on some of that deal flow for the benefit of our clients. We're going to shift gears just a little bit to talk about the client perspectives and our outlook. This chart that you see here is a survey by Greenwich Associates that surveys in this last the 2016 survey about 1,200 institutional clients to figure out what are their needs, what are things that are keeping them up at night, what are their objectives and priorities, how they're feeling about different things. And one of the comments that came out of here, which I think is overwhelming, is in that first area, the largest challenge for clients that has been identified, and it's been increasing over the last few years, is the rate of return and funding issues that they have for their portfolios. And as you can see, it's grown to 62% of the respondents saying that they are concerned about how are they going to get their returns. Conversely, there's the risk management side, which is about midway through that chart. Concerns there and the challenges there have declined. down to about 21% of the respondents. And you can see the chart up to the right that's embedded there by the type of clients and where their concerns are, that the rate of returns is very high, and especially for for most client types, but certainly for the endowments and foundation and the publics, 3/4 of the respondents saying that that's a concern for them. And if we flip over to the next chart, I'm sure you've seen this information, but types of, what is happening to the real GDP growth since the prior expansion peak. And the one we're in now is that dark blue line along the bottom, starting from the peak in the fourth quarter of 2007. And you can see that it's, the duration of that expansion is increasing, and we're approaching some of those longer durations that we have seen in prior, but the message here is, as we all know, is that the growth has just been so much slower, well below, and so this is putting a lot of pressure on our return expectations across the board, and creating challenges that we're seeing from an asset allocation perspective, and where we're looking for the opportunity sets. The next page is our 5 to 7 year return expectations. And this just highlights where we feel that the return expectation should be, and the change from the prior year. And so just to highlight a few of the changes, our inflation outlook has increased from about 2.25 to 2.5, and that has implications for some of these asset classes as well. And I'm not going to go through these individually, but some of the primary changes and where we're seeing changes in portfolios, you'll see that our TIPS expectation has increased about 50 basis points to 3%, and so we are allocating, recommending clients allocate a portion of their core bond exposure to TIPS because of our increased inflation outlook. And we also see some other dynamics that are going on here, and so for example, our U.S. large cap equity return expectation is down slightly at 5 3/4, and compared to our international or non-U.S. developed at 7 1/4, means that we are recommending that clients overweight our non-U.S. equities to an underweight in the U.S. And then finally, the other change I would highlight is in the high yield bonds. With the run that we have been on and the current outlook, our return expectations are down about 50 basis points, and so we are doing some reallocation there as well, to more bank loans and some other opportunities that we think are attractive relative to the high yield. I will comment that these these are the 5 to 7 year expectations, and you can see in the bullet point at the bottom of the page, our 30-year expectations, our long-term expectations, are largely unchanged, and still reflect the sort of subdued capital markets assumptions that we have seen. And so what does this mean for our portfolio construction? You can see on this chart where we have been able to achieve, a 7.5% long-term expected rate of return. Back in 2002, we could achieve that with, a large part, 50% of the portfolio in U.S. equities, 40% in core bonds, and 10% in high yield. So a relatively simple asset allocation to achieve the 7.5%. Fast forward to 2012, and to achieve that 7.5% return, we've had to move from U.S. equities to global equities and increase that amount a little bit to 55%, adding in a little bit more in the high yield bonds to take on a little bit more risk, and of course taking down our core bonds so that we can achieve those returns. And that of course is reflected in the volatility numbers that went from 10% to about 12%. Fast forward to today, so 5 years later, and we've had to achieve those expectations, we need to really add some more complexity to the portfolio. So that green bar at the top with the private markets at 15% of the portfolio, really adding as additional return expectations, taking out a little bit of the high yield from where it was in 2002, and decreasing our core bonds still a little bit more, as well as decreasing the equity, the global equity, slightly. So what the message here really is that our these portfolios have to become more complex to achieve these goals, and as such, we look to our managers to add, or that we understand that they too need to, you too need to increase the complexity of the portfolios in order to achieve the return objectives that you hope to. I will mention again, these are our long-term assumptions, our 30-year returns, so they don't necessarily sync to the 5 to 7 years that we have in the prior chart, but I just wanted to highlight that in terms of the long-term versus the shorter, medium-term expectations. So finally, what does that mean for our outlook and what we're doing to our portfolios? As we mentioned, we think that inflation is going up marginally higher in the coming years, and then as we look towards what's going on with the Fed and that balancing act that they have in terms of increasing rates and making sure that the dollar is not disruptively strong from a global market perspective, and sort of going back to the charts that we showed on the returns, less easy or more difficult for our clients to achieve those objectives in ways that they have in the past. Another area, the private markets portfolio, having a mature private markets portfolio is key to helping our clients meet their goals, and most of our clients have, fortunately had, private markets in their portfolios for quite some time, and so, that helps from that maturity perspective, but it also has implications for when we're starting with new portfolios in terms of how do we achieve some of that, whether it be through secondaries or some other options for new portfolios that don't have that private markets option in place currently. And finally, as we talked about, the complexity of the portfolios, mean that, or we have to have more complex portfolios to meet those objectives. And then, a key that a characteristic that we've seen in the last few years, and I know all of you are feeling this as well, is how our clients and how do we achieve those core beta exposures at a lesser cost because of the low return environment, because of pressures in institutions for funding. Everyone's looking to reduce fees where they can and where it makes sense to do. So we look for opportunities all the time in terms of how to help our clients meet those needs and do so in a cost-effective manner. And so there is a lot of pressure on the fees and figuring out how we can source those sources of beta in a lower cost manner. That wraps it up for the outlook. I'm going to turn it over to Hayley to talk about our research, I guess.
Great, thanks, Christy. This is Tim. I just wanted to jump in really quick and remind everyone, I don't think I said this explicitly, I mentioned we'd have time for questions at the end, but feel free. I think in the panel on the right-hand side there is a place where you can send questions in. Happy to take questions, and then a reminder that we will have the slides available. We'll send them out to all attendees, and they'll be available on our website afterwards. Thanks. Hayley?
So just actually to pick it off right where Christy left it, I'll walk you through a few topics that are top of mind and give you a snapshot of our research organization and walk through a broad research framework, I guess more specifically to the traditional side. And the first one is, the first topic I want to mention is active versus passive. This is becoming more and more of a starting point for asset allocation decisions, and the headwinds for active management are real and growing. And this is probably not surprising to anyone, especially for most of you on the call who live this every day. But just to put some numbers on the magnitude of how much passive has grown, if you look at the two pie charts on the right-hand side, 18% of overall portfolio allocation in the last year was passive. And then if you dig down a little bit, in U.S. equities, the active allocation to passive was 42%. And there are good reasons for this. So 98% of the active managers in U.S. equities have trailed the benchmark over a 10-year period. Our clients are resource constrained, so there's a real desire for just simplification. The fee pressures are mounting, especially when active managers underperform, and then the alternative is just so cheap. And last but not least, more value are being placed on asset allocation advice as clients seek not just an active management allocation, but an overall solution for end goals that they're trying to achieve. Having that said, the next slide shows that it's not all gloom and doom in the active world. There are factors in the marketplace that are still in favor of active management. Passive is gaining share, but it's gaining share in a growing pie. So if you look at the institutional asset pool overall, the pie chart shows, or the chart on the right-hand side shows AUM that's growing. That's both U.S. and globally. The increasing complexities of markets are still a barrier for entry for passive strategies. Active managers still enjoy a very healthy bottom line, coupled with continued growth in the overall AUM in the market. This enabled the investment managers to innovate, coming up with new products, distribution, solutions, and broaden and deepen partnership with clients. So the last slide on active versus passive. This slide tries to highlight and contrast the dispersion of how much share active has lost to passive in more traditional asset classes versus the non-traditional side from 2010 versus last year, 2016. On the more traditional side, the gap of 10-20% basis points lost to passive is sort of consistent across those asset classes versus on the more non-traditional side, the U.S. high yield, the EM, diversified equities, you're looking at much smaller, generally, loss of the pie from active to passive. In the next few slides, I'm going to walk you through just a few slides on our research organizations just to highlight and give you the transparency so you know exactly which group, who's in which group, who covers what. This is largely meant to be a reference point for you. So I should mention, actually, that these slides will be emailed and posted on our website after the call. So these will be reference materials to you. So if you have strategies that you want to bring to our attention, you know exactly who to contact within the research department. And then after that, I'll go through an overview of how we conduct our research process specific to the traditional side. And then we'll give you an example of an area of research focus. So as I mentioned, this is the overall organization headed by our Chief Investment Officer, Tim McCusker, who you heard from recently. Kristi recently joined us as our Head of Taxable Research on the right-hand side. And then we divided up largely into our asset allocation, traditional research, and alternatives. And you can take your time and refer to this material later on, all the different individuals who cover different parts of the markets and asset classes. The next slide focuses on traditional research. It's broken down into equities and fixed income, and you can see all the specific coverage of sub-asset classes here. And the third slide on our research organization focuses on the alternative side. And now I'll walk you through just very broad stroke on what our research framework is like, how we conduct our mandatory research and generate ideas. We start our process by screening the universe, and we usually combine both the Morningstar and investment, and we apply quant scoring to identify managers by three key criteria. One, the most important to us, is have you done it? Meaning, have you delivered risk-adjusted alpha consistently? Secondly, sustainability. We need to know what the thesis is, and we need to have confidence in the manager's edge, whether or not that can be maintained over time going forward. And lastly, but importantly, the stability of the firm and the investment team. This is an example specifically to small cap growth. So I don't cover equities, and I don't cover small cap, so you can't really ask me, all the specific to these numbers. Steve Gargano would be your person. But here, this is just to illustrate our process. We look at investment, we look at the Morningstar universes, we funnel them down step by step to eventually arrive at a merged list of 249 unique strategies within small cap growth that qualify for further analytics. After we have this list, well, specifically Steve would go and use our and funnel this 245 strategies through our proprietary quant tool to systematize the analysis that we do on all the managers. We generally focus on net of fees alpha. That's very important to us. And what's attractive for us is a long track record that's consistent, and that's net of fees performance, again, over the benchmark. We then, we have a scoring system that is based on various different criteria, as you can see here. The scoring channels generally help us research analysts to focus on the strategies that deliver excess returns over the long period of time. The very last topic that I want to touch on, and I think Kristi and Tim both sort of alluded to earlier, that's fees. That sort of ties back to the remarks that I made earlier when we were talking about active versus passive. This is not a new topic, but the focus on fees continues to heighten. And because passive has been taking shares from active, both from the active underperformance point of view and a big fee cut that passive can offer. We and our clients are very focused on this. So when clients run searches with us, they'll see the fee schedules of all the featured managers on there. And when applicable, the NEPC negotiated fees will be reflected on the search books. We currently have over 70 managers who are offering preferential pricing to NEPC clients. We continue to look for ways to partner with managers on creative commercial structures that would align the interests of all parties involved. So our clients, you, the managers, and us, that means delivering value to our clients, providing reasonable fees to you, the asset managers, and rewarding those managers who meet and exceed expectations. So with that, feel free to send in the questions through our panel, but I'll turn it back to Tim.
Great. Thanks, Hayley. So I wanted to wrap up with just a little bit on search activity and then some final thoughts. First, some transparency on where we saw activity last year. You can see the totals are large, over 700 searches across all asset classes for the year, placing over $30 billion. A few of the key themes here are, one, a lot of that activity was in non-traditional asset classes, multi-asset strategies, and then pure alternatives, hedge fund, real estate and real assets, private equity, and then a small emerging category there, liquid alternative beta, which we're seeing increased interest, at least, if not demand yet from clients. Certainly a lot of products hitting the marketplace. A lot of different strategies can fall into that category, but I think a lot of investors, and we at NEPC are interested in some of these creative factor exposures that can give you systematic exposure to more unique sources of return than traditional betas, not at the price of full active management necessarily. It's about 200 searches total in equities, so close to 40% of our overall activity, somewhere or close in that ballpark, a little 30%, I guess. And you can see a lot of that was in international and global. Half of that 200 was in global and emerging. Less activity in the U.S. equity space. We did see a decent amount last year in fixed income and U.S. fixed income, driven by a recommendation that we were making at the beginning of the year that we continue to make, that there's some opportunity to shift out of traditional core bonds into TIPS to protect a little bit against inflation if we do get a rising rate environment in an inflationary way. And then you can see that activity over time to pick up on some of the trends. You can see some of those themes here, like the increase in activity in U.S. fixed income and the number of searches in the bottom chart. You can see it's been pretty consistently for several years now in that $30 billion range of activity year over year for 3 or so years. So we're not looking to churn through searches and just do searches for the heck of it, but with some of those challenges and perspectives that you heard about from Kristi and Hayley, both on the market environment and return expectations, but then that active versus passive discussion, and clients thinking about how they want to use managers and active strategies in the future, that's driving a decent amount of activity for us and keeping that activity fairly high. So to wrap up, just some ways to work with us and engage with us. We're trying to post as much as we can on our website. That's for clients and prospects to see, but also for managers, so feel free to check that out on a regular basis. It's got a new look and feel that we're pretty happy with. We'd love any feedback that you have on that. I know that in a lot of ways the manager-consultant relationship can be a no business, but we do want to see your best ideas. It's that no is driven by some of the numbers that you saw on one of those charts from Hayley, that we start with 12,000 managers in a universe, and we've got to get it down to a few hundred across all asset categories that we think are the very best ideas. So by definition, we've got to cull that down quite a bit. But we want to partner with managers. We want to partner with the asset management community to find great ideas and deliver those to clients. I think that works best when we're focused on quality and not quantity. That it's not about the number of meetings that you get with us, but a few meetings on really good products, and then it understands the role that we're playing, that we're trying to narrow that universe down. What we will try to do is be responsive and give you feedback when we do have to say no, when it's not a productive conversation. We'll try to tell you why, so that you can have a good understanding of that and share that with your organization. You can expect us to remain transparent and give you information about what we're seeing from clients and where we're seeing search activity through things like the webinar today, but also just our regular one-on-one interactions. Try to get our market views out to both clients, prospects, managers, anyone that's interested in being on our mailing list. I think we hope to be transparent and open about the things that we're thinking about in markets and in placing assets and implementing. We try to share how our framework for evaluating managers, and that's part of our feedback process when we're giving information about why or why not we're engaging with you. Try to fit that into our process. As I said, we try to be responsive and try to give you that feedback. So we do have a couple questions here. If you do have questions, please feel free to add to that and submit those in that panel. While you're thinking about questions, just a few upcoming things for us. We have our annual investment conference coming up next week. Very excited about that. It's our 22nd annual conference and a great way for our clients to engage with us. And from time to time, we have managers coming in as expert speakers. So thank you to all of you over the years who have participated that way. And then we're regularly out on the conference circuit, sharing some of our knowledge, interacting with clients and managers. So look for us at these upcoming events, but also throughout the year. And if you see opportunities where you think we could add to the agenda of a conference, we're open to hearing about that. So why don't we cycle through some of these questions. First one, maybe for Kristi, going through the market outlook first, and a question on infrastructure. Certainly a hot topic post-U.S. election. How are we thinking about opportunities in infrastructure, both listed or unlisted, and do we see it as a good inflation hedge?
Yes. The answer is that, as Tim mentioned, even on the search activity, we've had a lot of activity in the real assets area. Some of that driven by some of our inflation expectations, both in real estate and real assets, and then some activity around MLPs. And so, we're definitely positive on that area. We often have FLP managers that are, we regularly have, I guess I should say, managers that are on our list in the infrastructure space. So Tim, did you have any other specifics that you can add to that comment?
Yeah, I think we have been, on the private infrastructure side, historically we've been somewhat skeptical that there was a lot of money chasing that area, and so valuations were somewhat rich, didn't see the income being in line with the amount of risk and illiquidity that you're taking on, and thought the fees were fairly high for what you were getting there. We are evaluating it more closely now. We do think it's an interesting inflation hedge. Need to do some more research there, but definitely evaluating it given some of the rhetoric around infrastructure spending. We think we have some time for that, though, that there's really no such thing as a shovel-ready project, and that if we do get some infrastructure spending, it's going to take a while to get implemented. We've been less constructive on listed infrastructure. We've seen that more as equity beta, so a little less research on that side for us. I want to go to a question on process here. This one's for Hayley. The question is on elaborating on our preferred strategy assessment process around timing. We have a netting and vetting process that is sort of on a rolling calendar. Can you talk a little bit about that, the timing across categories?
Yep. So generally, we have sort of various different preferred focus lists. And for us, there's some lists that are refreshed more frequently. Those are called the A lists. And then we have B lists that are, less activities, less searches, that will be refreshed less frequently. Usually the cycle is, for A list, 12, 18 months, and then for B list, it gets to 24 months. That being said, if it's a really compelling strategy, if something opportunistically is happening with, maybe a strategy that's not on our preferred list, it's been closed for a while, we've known the manager with huge confidence, it now reopens, and really it's a great opportunity for our clients to get in, for instance, then our committee, due diligence committee, meets every other week, and we can also have meetings in between as well to vet these ideas. It's far few in between, but that's also an option. And more generally, I would say, the real estate on SPLs are limited. Those are supposed to be our best ideas, and those are the ones that we have the most conviction in. But having that said, you can still it's still good for us to get to know you, because sometimes for public searches, for client exposures, we want to work with you guys, and we want to get to know the landscape. It's our job to know all the different managers, the different strategies, and we're continually trying to assess, the ideas we have, look at new ideas, and see the strengths of our ideas and our conviction.
Great. A couple more here. This is a question on hedge funds. I think I'll take the first part and then let Christy chime in as well. Do you maintain return expectations for hedge funds, either broadly or by strategy/sub-strategy? Then what are your thoughts for the role of hedge funds in portfolios? First part, yes, we do come up with assumptions for hedge funds. We do it based on a few major sub-strategies: equity hedge funds, credit hedge funds, event hedge funds, and macro hedge funds. We try to think about what's the underlying beta, and both what that beta is definitionally, and then how much beta on average we expect that type of strategy to have. So that synchronizes with our beta assumption, whatever it may be. So for equity long short, it would be equities, and it lines up with our assumption for equities. There's a cash component and then a small alpha component as well. Our hedge fund assumptions right now across those categories are in the 5 to 6% range. So subdued relative to history. Much of that is driven by low cash rates. When your cash rate's low, to add 3 to 5% on top of that, you're not getting much above 5, 6% for a return. And then I'll turn to Christy to chime in on views on the role of hedge funds in portfolios.
Yeah, so I mean, as you all know, hedge funds are not all created equally, and so I think that we holistically look at the portfolio and figure out where hedge funds can make sense. And so, there are times when hedge funds can, be their own allocation as a general portfolio, and other times where it makes sense, depending on the types of strategy, where you think of them, as Tim was talking about, in sort of the beta opportunities. So, long biased, long short hedge funds are very different than, say, a neutral long short hedge fund, which are very different than, say, a relative value hedge fund. So we do think that there's a place in the portfolio for hedge funds, and we think that it's a nice, added value. In many ways, you hedge fund managers are coming up with unique alpha streams that you're not finding in the more traditional asset classes, and so that has to be considered, overall as well. And so, we pride ourselves on doing a lot of thorough due diligence on our managers to understand that, while an asset class assumption may say one thing, the practicality of implementation is different because, again, the uniqueness of the managers and the manager's strategy. But hedge funds remain a portion of our asset allocation.
Thanks, Kristi. We're just at about 45 minutes here. We do have a couple other questions, more firm-related questions that I think are relevant, so I'll hit on them quickly. One is the fiduciary rule. Does that change NEPC's business model? Do we have to adjust in advance of that? And I'll answer it in terms of the fiduciary rule as it's understood right now. I don't know if there will be any changes to it. Certainly, that's up for speculation as it's been delayed. But the great news for NEPC is that we've always served as fiduciaries along with our clients. So the fiduciary rule was welcomed by us. It was an affirmation of the way that we've worked with clients for over 30 years. And if anything, just meant that the market had to come to us a little bit. So no changes for us. We'd like to see it get implemented, and it's a good thing for us. And then the last question here, can you share an update on your discretionary and OCIO business and how my managers work with us in that space? So our discretionary business has been a source of growth for us. It's roughly 10% of our business, maybe a shade more than that now, and is an area of continued demand. You saw at the beginning, we showed you the different client types that we work with, and we have discretionary clients in all of those client types at this point. So it's an area of focus and growth for us, and we've had managers. We don't run pooled products the way some other OCIO models are structured. We build customized bespoke portfolios for each client that comes on as discretionary, but there is an element of scale with the managers where we're not going to have a manager in every single portfolio, but there'll be a lot more overlap. And I think there is an opportunity there. Working with managers that have been through our research process and have been approved, we've been able to engage with them and explain that we're looking to put them in discretionary client portfolios and asking them to recognize the fact that they'll have one interface through NEPC and not really much exposure to those clients, so the client service would be more limited, and to look at some better some fee discounts as a result of that. And we've been able to pass that on to clients, which is great. So with that, I want to thank everyone for joining today. Always appreciate the fact that folks hop on here and listen to what we have to say, and appreciate the partnership that we have with the investment manager community. Look forward to continuing to work with all of you to help meet and exceed our clients' return objectives. So thank you, and have a great day.